Inflation is stickier than ever, and it's not going away, at least not yet. Armed with this knowledge, we can actually take advantage of the current trend and anticipate its next move. But for that reason, the Fed is not going to let up. We dove into the details of our latest inflation report, and we're going to show you exactly where prices are surging and why stocks are so strong. We're also going to show you our unique take, which most might not consider. The Consumer Price Index, a basket of goods and services, rose 3.2% from this time last year. Marking an increase from last month, this update serves as a disappointment to those hoping for a reduction in borrowing costs within the next few meetings. Let's also consider the core CPI, which excludes the more volatile components of the inflation report, food and fuel. Core CPI on a year-over-year basis was reported at 3.8%. While the latest figures do show a continuation in the overall trend to the downside, we're still well above the 2% target, where we may anticipate an eventual rate cut. Let's examine what's going on within this month's CPI. As core CPI, which excludes energy, rose more than the standard figure, it is clear the weakness in those energy prices was the result, declining 1.7%. And some good news at the gas pump. The rate of inflation in gasoline prices has declined 3.9% on a year-over-year basis. This decline is also illustrated in the surge in those services excluding energy, surging 5.2% indeed. In fact, the energy component of inflation appears to represent the weakest. So, that begs a question, where exactly is the inflation? To answer that question, we look to housing, which exceeded the overall index with an annual increase of 4.5%. Not to mention the inflation in rent surging 6% from the same time last year. While these figures still convey an inflationary story, let's give credit where credit is due. We have made quite a bit of progress in the Fed's fight to cool prices. For those of you that have felt the pinch at the restaurants, you're not alone. While overall food inflation is up only 2.2%, food away from home is up 4.5%. Just consider how much food prices have actually declined from peaks of August 22. From 11.4%, food prices have now only registered a 2.2% rate of growth. For those of you that like to eat out, there's more good news. From 8.8% highs achieved in March of last year, CPI food outside the house is now only up 4.5% year over year. Again, that weakness in energy prices is a major contributing factor to a calming trend in inflation. Amazingly enough, this month's report now registers around an entire year of continuous declines. The decline in gasoline inflation is even more impressive. The current 3.9% annual decline perpetuates a trend which began all the way back in December of 22. So why exactly are stocks so strong? Stocks are strong, in fact, as part of the inflationary cycle. Inflation is caused by rising prices. Prices rise when there's more demand than supply. This occurs in a strong housing market or any market for that matter. Inflation is a natural occurrence as a result of organic economic growth or when the Fed floods the system with cash during times of stress. So, why doesn't the Fed cut rates? Two reasons. Number one, we still have a good amount of inflation. Despite falling energy prices, the Fed feels there is still a sufficient level of inflation to warrant the current high rate environment. Number two, the jobs market looks strong. Well, not by all measures, but the latest non farm payrolls have granted the Federal Reserve more time to wait. Based on at least this view of the economy, the employment sector looks strong. While stocks in the CPI continue to surge, here's a different perspective to consider. Going back about a year, in blue we see the CPI monthly changes and in yellow the S&P 500 monthly changes. The correlation between the two is quite clear. Why is that? Inflation is an increase in the price of goods and services. Corporate earnings rise, corporations receive higher prices. Investors and analysts anticipate strong earnings. Stocks and inflation rise together, meaning economic growth. Moving forward, if we continue to see strong stocks, it's logical to conclude reports from future inflation may not subside. Recent data paints a vivid picture: persistent inflation, robust job growth, and surging stock prices. As we approach the inevitable pivot point, we can be certain that all three barometers will shift accordingly. Will a procrastinating Federal Reserve lead us towards a tale of a hard landing, or will a judicious monetary policy management result in a controlled descent and a smooth touchdown? Only time will tell. Much like a daring leap over a metaphorical shark, true success will only be apparent once we've safely touched down.